January 27th, 2026. Silver is trading at $111 per ounce. Just 24 hours ago, it hit an all-time high of $117.69, obliterating the 1980 record of $49.45 that stood for 45 years. But that's not the story I'm here to tell you. Because while Western investors are celebrating triple-digit silver, something far more significant just happened in China. Something that reveals the real endgame unfolding right now. A Chinese silver fund, the only pure-play silver investment vehicle available to 1.4 billion people, just halted trading. Not because of a technical glitch, not because of regulatory paperwork. It halted because Chinese investors drove the premium so high, created such a buying frenzy, that the entire structure became unstable. The fund was trading at over 50% above the value of the actual silver it held. Think about that. Chinese investors were so desperate to get exposure to silver that they were willing to pay 50% more than what the metal was actually worth just to own a piece of paper that represented it. This is not normal market behavior. This is not speculation. This is panic. This is what happens when the world's largest manufacturing economy, the world's largest consumer of industrial metals, the world's second largest economy, realizes that the supply of a critical strategic material is about to get cut off. And they're right to panic. Because what most people don't know is that on January 1st, 2026, China implemented new export licensing requirements for silver. The quota system that existed for years was replaced with a strict licensing framework. Only 44 companies are now licensed to export silver. For the 2026-2027 period, only entities with annual production capacity of at least 80 tons qualify. This isn't a trade policy adjustment. This is supply lockdown. The message is clear. China is keeping its silver. And when the world's largest silver consumer decides to hoard instead of export, the rest of the world is left scrambling for scraps. The Chinese fund trading halt is the canary in the coal mine. It's the market screaming that physical silver is about to become the most fought-over commodity on the planet. In the next several minutes, I'm going to walk you through exactly what happened with this fund, why Chinese regulators had to step in, what the 50% premium tells us about real supply and demand, and why this event confirms that we are in the early stages of the greatest supply shock in precious metals history. Because what happened in China last week isn't just a local story. It's a preview of what's coming to every silver market on Earth. The premium collapse, the trading halts, the regulatory intervention. This is the pattern that repeats when paper promises collide with physical reality. And silver, more than any other asset on the planet right now, is caught in that collision. Let me show you exactly what went down. The fund at the center of this story is the UBS SDIC Silver Futures Fund. It's a listed open-end fund trading on the Shenzhen Stock Exchange under the code 1622411. This is not some obscure derivative product. This is China's only pure-play silver investment vehicle, available to retail investors. If you're a Chinese citizen and you want exposure to silver without buying physical bars, which come with VAT taxes and storage headaches, this fund is your only option. The fund holds Shanghai Futures Exchange, silver contracts. It doesn't hold physical metal, it holds paper contracts representing silver stored in Shanghai warehouses. This is critical to understand because it means the fund is subject to the same paper versus physical dynamics that plagued the COMEX in New York and the LBMA in London. When demand for the fund exceeds the available shares, the premium over net asset value expands. This is basic supply and demand. If there are 100 shares of the fund and 200 people want to buy, the price of those shares goes up relative to what the underlying silver is actually worth. In a normal market, when the premium gets too high, the fund manager issues more shares. They use the incoming cash to buy more silver futures contracts. This keeps the premium in check, usually within a few percentage points of the net asset value. But starting in late 2025, something broke. The fund began trading at massive premiums. By late December 2025, the premium hit 62%. Let me put that in perspective. At a 62% premium, if the silver futures the fund held were worth 100 yen, investors were paying 162 yuan for shares of the fund. They were overpaying by more than half just to own exposure to silver. Why would anyone do this? Because they couldn't get silver any other way. The physical market in China was sold out. Dealers had waiting lists. Premiums on physical bars were soaring. The government's January 1st export restrictions were already being priced in. Chinese investors knew that if silver supply was about to get choked off, the price had only one direction to go: up, so they piled into the fund. Retail investors, institutional players, anyone who could open a brokerage account started buying. The fund's trading volume exploded. On some days, it was one of the most actively traded securities on the entire Shenzhen exchange. But then, on December 26, 2025, the bubble popped. The fund crashed 10% in a single day, hitting the lower circuit breaker limit. The 62% premium collapsed to 44% overnight. Investors who bought at the peak were suddenly sitting on massive losses. Panic selling ensued. The very same people who were desperate to get in at any price were now desperate to get out at any price. But the crash didn't kill the demand. By mid-January 2026, the buying resumed. On January 21st, the fund's premium was back over 50%. The fund price hit 3.92 yuan, while the net asset value was only 2,598 yuan. Investors were once again paying more than 50% above the actual value of the silver. The fund manager tried to cool things down. On December 26th, they had already tightened subscription limits from 500 yuan to just 100 yuan per investor per day. That means you could only buy 100 yuan worth of the fund each day, roughly $14 US. This was designed to slow the inflow of money and prevent the premium from spiraling out of control. But it didn't work. Chinese investors found ways around the limits. They opened multiple accounts. They used family members' names. They bought every single day, hitting the 100 yuan limit repeatedly. The fund manager was overwhelmed. They couldn't issue new shares fast enough to meet demand. And even if they could, there was a deeper problem. The fund holds Shanghai Futures Exchange silver contracts. To issue new shares, they need to buy more of those contracts. But the Shanghai silver market itself was under pressure. Futures prices were disconnected from spot prices. The basis was blowing out. Liquidity was thinning. If the fund tried to buy massive quantities of silver futures to back the new shares, they would drive the futures price even higher, which would increase their own net asset value, which would require them to buy even more futures. It's a feedback loop, a doom spiral. The fund manager realized they were losing control. So on January 22nd, 2026, they halted trading for the entire day. And on January 23rd, they halted trading again from market open until 10:30 a.m. Beijing time. The official reason given was to protect investors and maintain market stability. The real reason was that the premium had become unsustainable. At over 50%, the fund was no longer functioning as an investment vehicle. It had become a speculation bubble. And the Chinese Securities Regulatory Commission doesn't tolerate bubbles. They step in, they halt trading. They force liquidation if necessary. They protect the system, not the speculators. The trading halt sent shockwaves through the Chinese investment community. Social media exploded. Investors who were locked out of their positions panicked. Those who had bought at the peak realized they were trapped holding shares worth 50% more than the underlying asset. If the fund was forced to liquidate or if the premium collapsed again, they would suffer catastrophic losses. But here's what the mainstream financial media missed. The trading halt wasn't the end of the story. It was confirmation of the bigger trend. Chinese demand for silver is so intense, so urgent, that investors are willing to overpay by 50% just to get exposure. That level of desperation doesn't come from speculation. It comes from scarcity. It comes from the realization that physical silver is running out and the window to secure supply is closing. Let me show you the numbers that prove this isn't just a Chinese phenomenon. It's global. In 2025, the UBS SDIC Silver Fund gained somewhere between 187% and 220%, depending on which measurement period you use. If you measure from the January 2025 low to the peak in late December 2025, the gain was over 200%. If you measure the calendar year performance, it's closer to 187%. Either way, this is not normal. A 200% gain in a single year for a commodity fund is extreme. It suggests that something fundamental has shifted in the supply-demand balance, but the fund's performance actually lagged the broader silver market. Shanghai Silver Futures, which the fund holds, gained between 128% and 145% in 2025. The global silver price, measured in US dollars, gained even more. From around 31 per ounce in January 2025 to the all-time high of 117.69 on January 26, 2026, silver has gained 279%. That's a near tripling of the price in just over 12 months. This is the kind of move you see in parabolic manias. Dot-com stocks in 1999, Bitcoin in 2017, housing in 2005. Except this isn't a mania driven by speculation. It's driven by industrial demand colliding with supply destruction. Let me break down what's actually happening in the physical market, because the fund premium is just a symptom. The disease is a structural deficit that has been building for years and is now accelerating. Global silver mine production has been declining since 2016. We've gone from roughly 900 million ounces per year to around 830 million ounces today. That's a 7% drop in output over nearly a decade. Meanwhile, industrial demand has exploded. Solar panel installations doubled in 2024. Every panel uses silver paste for conductivity. Electric vehicle production is up over 40% year over year. EVs use roughly 3 times more silver than internal combustion vehicles. 5G infrastructure build-out continues globally. Data centers for AI are consuming massive amounts of silver in electronics and cooling systems. The result is a structural deficit. The world is consuming more silver than it's mining. The gap is being filled by above-ground inventories, scrap recycling, and investment liquidation. But those sources are finite. Inventories can only be drawn down for so long before they hit zero. Scrap recycling is already maximized. And investment liquidation only works if there are investors willing to sell. Right now, they're not selling. They're buying. Exchange-traded funds saw net inflows in 2025. Retail demand for coins and bars hit record levels, and institutions are quietly accumulating. This brings us to China's role in the supply equation. China is the world's largest silver consumer, accounting for roughly 20% of global demand. Most of that consumption is industrial: solar panels, electronics, batteries, infrastructure. But China is also a major silver producer, mining around 135 million ounces per year. For years, China exported refined silver to the rest of the world. Chinese refiners would import silver concentrate, process it, and sell refined bars to London, New York, and other global markets. This export flow helped balance the global market. It provided liquidity. It kept premiums in check. But on January 1st, 2026, that changed. China implemented new export licensing requirements for silver and other critical minerals. The quota system was replaced with a licensing framework that dramatically restricts who can export and how much. Only 44 companies are licensed for the 2026-2027 period. Only entities with annual production capacity of at least 80 tons qualify. The licensing process is opaque. Approvals are discretionary. And the message is clear: China is prioritizing domestic supply. This policy shift is part of a broader strategy of resource nationalism. China controls the refining and processing of most critical minerals: rare earths, graphite, cobalt, lithium. Silver is now being added to that list. The impact on global supply is immediate. If China reduces silver exports by even 10%, that's roughly 13 million ounces removed from the market. The global deficit, already at 200 million ounces annually according to some estimates, widens further. Prices in London and New York have to rise to ration the available supply. And premiums in China have to rise because domestic buyers can no longer rely on imports to meet demand. This is why the UBS SDIC Silver Fund premium hit over 50%. Chinese investors know they're being cut off from global supply. They know the export restrictions are real. They know that if they want silver exposure, they have to get it now, at any price, before the window closes completely. The fund premium is a price signal. It's the market screaming that physical silver in China is worth more than paper silver in New York. It's arbitrage that can't be closed because the metal can't flow. In a normal market, when the fund trades at a 50% premium, arbitrageurs would step in. They would buy silver futures in Shanghai, sell shares of the fund, and pocket the difference. This would close the premium. But you can't arbitrage if you can't get the silver into China. Export restrictions prevent that flow, the premium persists, and it tells you the real price. Now let me show you why this matters for the global silver market. Because what happened with the Chinese fund is a microcosm of what's about to happen everywhere. The paper market is going to break. The premium between physical and paper is going to blow out, and investors holding paper promises are going to realize they own nothing. Look at the COMEX in New York. The registered silver inventory, the metal available for delivery against futures contracts, has been falling for months. It's currently around 32 million ounces. That sounds like a lot until you realize there are claims on over 800 million ounces in the futures market. The leverage ratio is roughly 25-1. For every ounce of physical silver in the vault, there are 25 paper claims. This system only works if most people don't ask for delivery. As long as traders settle in cash, roll their contracts, or close their positions before expiration, the COMEX can function. But the moment delivery requests spike, the system implodes. We're starting to see early signs of stress. Delivery requests have been rising. In recent months, 9% to 12% of open interest has stood for delivery. That's nearly double the historical norm. The registered inventory is draining faster than it can be replenished. And premiums for physical bars over the futures price are widening. The same dynamic is playing out in London. The London Bullion Market Association, the LBMA, is the center of the global wholesale silver market. Most of the world's silver flows through London vaults before being shipped to end users. But LBMA silver inventories have been falling. The Shanghai arbitrage has been draining metal from London to China. Refiners are shipping bars east to capture the premium. And once that silver arrives in China, it's not coming back. China's export restrictions ensure that. This creates a one-way flow. Silver moves from west to east, from London and New York to Shanghai, from paper markets to physical markets, from weak hands to strong hands. And when the flow becomes too imbalanced, the system breaks. The Chinese fund trading halt is a warning. It's showing us what happens when paper disconnects from physical. The premium explodes. Regulators step in, trading halts. Investors get trapped. And the smart money, the people who hold physical metal, walk away with the real wealth. Let me give you the playbook for what's coming. Because this isn't speculation. This is pattern recognition. We've seen this movie before. In 1980, the Hunt brothers accumulated 200 million ounces of physical silver. They drove the price from $6 to $49.45. The COMEX changed the rules, banned new long positions, and forced liquidation. The Hunts were destroyed, but the squeeze was real. The shortage was real. And the only way to stop it was to change the game. In 2011, silver went from $18 to $49 in a matter of months. Retail demand exploded. Mints sold out. Premiums spiked. The COMEX raised margins 5 times in 9 days to kill the rally. It worked. The price crashed. But the physical shortage was real. Dealers couldn't keep inventory on the shelves. In 2020, during the COVID panic, silver hit $28. But physical coins were selling for $45. That's a 60% premium. The paper price said 28. The street price said 45. The divergence told you everything you needed to know. Paper was worthless. Physical was priceless. Now, in January 2026, we're seeing the same pattern on steroids. The Chinese fund premium hit over 50%. COMEX registered inventory is at decade lows. Delivery requests are surging. Premiums are widening globally. And China just locked down exports. The setup is complete. The only question is timing. When does the break happen? When does the paper market finally admit it can't deliver? I don't know the exact date. No one does. But the indicators are all flashing red. The Chinese fund trading halt is one of those indicators. It tells you that the largest consumer market on the planet is already experiencing a disconnect between paper and physical. It tells you that Chinese regulators are worried about stability. And it tells you that investors are so desperate for silver exposure that they'll pay any premium to get it. That desperation is rational, because the alternative is being shut out entirely. Let me walk you through the mechanics of what happens when the paper market breaks. First, delivery requests spike. More traders demand physical settlement. The COMEX or LBMA can't fulfill the requests. Registered inventory drops toward zero. Second, the exchange declares force majeure. They invoke the clause that allows them to settle in cash instead of metal. Contract holders who expected silver get dollars instead. Third, the paper price and physical price diverge. The futures price might say $120. The street price for a physical bar might be $180. The spread is the fraud premium. It's the cost of discovering that your paper contract was worthless. Fourth, investors panic. Those holding ETFs, futures, and unallocated accounts realize they own nothing. They try to convert to physical, but it's too late. The metal is gone. Premiums are prohibitive. Delivery times are months or years. Fifth, governments intervene. They might ban private ownership. They might impose windfall taxes. They might nationalize mining operations. History shows that when strategic resources become scarce, governments don't respect property rights. They confiscate. Sixth, the price resets. The market finds a new equilibrium where paper and physical reconnect. But that equilibrium is at a much higher price. Because the supply hasn't increased, demand has only grown. And the losses from the paper collapse have scared investors into physical-only positions. This is the endgame, and the Chinese fund is showing us Act 1. The premium blowout, the trading halt, the regulatory intervention. We're watching the script play out in real time. The smart money is paying attention. They're converting paper to physical while they still can. They're accepting the premiums. They're accepting the wait times. Because they know that physical in hand is the only position that survives the reset. Let me give you the brutal truth that most analysts won't say. If you own silver ETFs, you own a liability. If you own futures contracts, you own a promise that might not be kept. If you own unallocated accounts at a bank, you own a digital entry that can be deleted. The only silver that's real is silver you can hold. Bars in your safe, coins in your drawer, metal that you control, that isn't subject to counterparty risk, that can't be frozen by a regulator or confiscated by a government desperate for resources. The Chinese investors who bought the UBS SDIC fund at a 62% premium in late December learned this lesson the hard way. They thought they were getting silver exposure. What they got was a trading halt and a collapsing premium. They paid 162 yuan for something worth 100 yuan. And when the halt lifted, if it lifts, they'll discover that the gap hasn't closed. It's widened. Because the underlying problem hasn't been solved. China still has export restrictions. Global supply is still in deficit. Industrial demand is still rising. And the physical metal is still disappearing into solar panels, EVs, and electronics, where it will never be recovered. The Chinese fund story is a case study in what happens when scarcity meets financialization. The fund was supposed to provide easy, liquid access to silver. But when real scarcity hit, liquidity vanished. The fund became illiquid, the premium became unsustainable, and the regulators had to step in to prevent a complete meltdown. This is coming to every paper-silver market. The COMEX, the LBMA, the ETFs, they all have the same structural flaw. They promise delivery of metal they don't have. They rely on the greater fool theory. the belief that someone else will always be willing to settle in cash. But when the music stops, when everyone demands physical at the same time, there aren't enough chairs. The Chinese fund had one advantage over Western paper markets. It was honest about what it held. Shanghai Futures Exchange contracts, paper. It didn't claim to hold physical bars. Investors knew they were buying paper exposure. And yet, even with that transparency, the premium blew out to over 50% because paper wasn't enough. Investors wanted real metal. Now imagine what happens in the West when investors realize that their silver ETFs, which claim to hold physical bars, might not actually have the metal. When they realize that the audit reports are outdated, that the bars might be double pledged, that the custodian bank might be using the metal for its own trading. The premium won't be 50%. It will be infinite, because you can't buy what doesn't exist. I want to end with this. The Chinese fund trading halt is not a bug. It's a feature. It's the system working exactly as designed. When bubbles form, regulators step in. When premiums blow out, trading halts. When investors panic, the market freezes. This protects the system, but it doesn't protect you. Your position gets frozen. Your profits get trapped. Your liquidity disappears. And when the halt lifts, you're at the mercy of whatever price the market decides. The only way to avoid this is to own physical metal. No counterparty, no regulator, no trading halt. Just you and the metal. The Chinese investors learned this lesson. The question is, will you learn it before the Western markets teach it to you the hard way? Because the signs are everywhere. The fund premium, the export restrictions, the inventory drawdowns, the delivery requests, the price explosion. We're in the early stages of the greatest supply shock in precious metals history. And the difference between winning and losing is simple. Physical or paper. Real or promise. Metal in hand or digits on a screen. The Chinese fund chose paper. The premium hit over 50%. The trading halted. The investors got trapped. Don't let that be your story. January 27th, 2026. Silver at 111, down from the all-time high of $117.69 just 24 hours earlier. A Chinese fund halted for trading at a 50% premium. And the world is just starting to wake up to what's coming. Like the video and comment your thoughts down below.